Hello everyone, welcome to Finance Focus. Today's video is about the global economic impact of the ongoing US-Israel-Iran conflict in the Middle East. Everyday life is where the tremors of global conflict are first felt. A person stopping to fill their car on the way home from work notices the numbers on the pump climbing faster than they have in years. Digital gas pump close-up showing rapidly rising prices. In California, prices have already surged past $5 per gallon, a direct consequence of events unfolding thousands of miles away. This is not an abstract economic theory. It is a tangible cost that reduces the money available for other necessities. The national average gas price has jumped by 65 cents since February, a stark reminder of how interconnected our world has become. The war in Iran, which began with surprise airstrikes on February 28, 2026, is not just a distant headline. It is a force actively reshaping household budgets across the globe. This daily reality extends from the gas station to the grocery store. Families are discovering that their weekly shopping bill is growing, even for the same basket of goods. The conflict's impact on supply chains means that the cost of producing and transporting food is rising. This pressure is felt by everyone, but it lands most heavily on those with the tightest budgets. It is a story about how geopolitical tensions in a narrow strait in the Middle East can ripple outward, touching the lives of billions and forcing difficult choices in kitchens and on commutes around the planet. Small business owners, from local bakeries to delivery services, are also on the front lines of this economic shock. They face the dual challenge of rising costs for their own supplies and operations, while trying not to pass on those full costs to customers who are already feeling the pinch. A local restaurant, for example, must contend with higher prices for cooking oil and flour, as well as increased delivery fees from its suppliers. These incremental increases accumulate, threatening profit margins and, in some cases, the very viability of the business. The human cost of this conflict is therefore not only measured in the tragic loss of life, but also in the economic strain that threatens livelihoods and community stability far from the battlefield. Understanding this connection is crucial. The conflict between the United States, Israel, and Iran is not just a regional dispute. It has become a global economic event. The global economy runs on oil. It fuels our cars, heats our homes, and powers countless manufactured products. At the heart of this network lies a single narrow waterway, the Strait of Hormuz. This choke point is the most critical artery for global energy trade. Roughly 1/4 of seaborne oil passes through it, and about 1/5 of global liquefied natural gas. When that passage is threatened, markets hold their breath. The recent conflict turned that threat into reality, producing what some call the largest supply disruption in the modern oil market. After initial military strikes, Iran's Revolutionary Guard warned ships not to pass. That warning became an effective closure. Normal traffic, about 138 vessels a day, collapsed. It fell to a mere trickle. Soon after, more than 150 ships anchored outside the strait rather than risk passage. Supply dropped dramatically, and markets felt it immediately. Brent crude surged over 10% in the immediate aftermath, climbing from roughly $70 to over $80 a barrel. The principle was simple: supply and demand. With a large portion of daily supply offline, remaining oil grew far more valuable. Traders and nations scrambled, bidding prices higher. Iran then threatened to stop a liter of oil from passing through Hormuz, and some officials warned prices could spike to $200 per barrel if the blockade continued. That extreme projection was possible but unlikely. Nonetheless, prices stayed elevated, crossing $100 a barrel as the crisis deepened. This disruption dwarfs the Russia-Ukraine impact. Transit through Hormuz is now near a complete shutdown of a primary global route. The IEA confirmed traffic fell to a fraction of normal volumes, and the few ships attempting passage often claimed links to China. The moment forced a global reckoning on fragile energy supply chains that for decades depended on secure tanker passage through this strait. While the surge in oil prices captures headlines, a quieter but potentially more dangerous crisis is unfolding in the world's agricultural sector. The same Strait of Hormuz that is a choke point for oil is also a critical artery for the global fertilizer trade. More than one-third of all globally traded fertilizer passes through this route. With commercial traffic now largely halted, these vital shipments are not reaching their destinations. This disruption could not have come at a worse time. Farmers across the Northern Hemisphere are preparing their fields for spring planting. Without access to these essential nutrients, crop yields are at risk and global food prices may rise long-term. The importance of synthetic fertilizers to modern civilization cannot be overstated. Researchers estimate roughly half the global population, about 4 billion people, is alive today because of higher food production from these chemicals. They are the foundation of the industrial nitrogen cycle, enabling food for 8 billion people. The conflict's impact extends beyond the flow of oil and fertilizer, causing massive disruptions to the global logistics networks that underpin modern trade. In the skies, the airspace over Iran became a no-fly zone almost instantly. Following the initial strikes, Bahrain, Iraq, Kuwait, Qatar, the UAE closed their airspace to civilian aircraft. This created a vast corridor of grounded planes and canceled routes, a mass disruption for the aviation industry. International carriers like British Airways, Lufthansa, Cathay Pacific suspended services to the Middle East. Over 4,000 daily flight cancellations stranded hundreds of thousands of passengers, turning airports into crowded waiting rooms filled with uncertainty. Journeys that once flew directly over the region now require lengthy detours, adding hours to flight times and operational costs. Financial markets are barometers of global sentiment, and their reaction to the Iran conflict was swift and decisive. The core principle driving markets is the pricing of risk, and war introduces a profound level of uncertainty. In the hours and days following the initial airstrikes, investors around the world moved to shed risky assets. Stock markets saw declines as the prospect of higher energy prices disrupted trade, slowing economic growth simultaneously. Investors flocked to so-called safe haven assets. Gold rose. The US dollar strengthened. Other stable currencies rose. The most immediate reaction was in energy markets. Oil prices surged on supply disruption. Airline stocks tumbled on higher fuel costs and canceled routes. Shipping companies with Middle East exposure fell. Defense contractors rallied. Some energy producers rallied. The result? A volatile trading environment that flips on the latest headlines. The economic shockwaves from the Iran conflict have created a severe dilemma for central banks around the world, particularly the U.S. Federal Reserve. The war is simultaneously pushing inflation higher while threatening to slow economic growth, a toxic combination known as stagflation. The surge in oil prices is a direct inflationary pressure. Energy is a key input for transportation and manufacturing. Higher oil costs ripple through the economy, pushing up the prices of goods and services. The disruption to fertilizer supplies adds another layer of food price inflation, directly impacting consumer budgets. This forces central bankers to confront a difficult choice. The standard tool to fight inflation is to raise interest rates, which makes borrowing more expensive, cools demand, and slows the economy. However, raising rates amid disrupted trade and falling confidence could tip it into a recession. Keeping rates low risks allowing inflation to become entrenched, eroding purchasing power and stability. Forecasts are being revised, inflation higher, growth lower, and recession risks rising. As the world grapples with the immediate economic consequences of the war, the crucial question is, how long will this last? Scenario 1. A short-lived conflict. With diplomacy or a decisive outcome, Iran might lift its blockade. Oil, LNG, and fertilizer shipments resume. Oil prices would likely fall as tankers move again. Analysts say gas prices could drop within weeks. Supply chains adjust. The inflationary shock peaks and recedes. Markets rally, and recession risks ease. Scenario 2. A protracted conflict. The Strait of Hormuz blockade remains, with heightened military risk. Oil stays high and could spike to $150, even $200 per barrel. A sustained fertilizer shortage risks poor harvests and a global food crisis. Each week adds 25 to 40 cents at U.S. pumps. Stagflation deepens as central banks weigh painful choices. Growth slows markedly, with the worst pain in developing countries as supply chains reroute permanently and costs rise. In the face of such a significant economic shock, inaction is not an option. Governments must act, coordinate stockpile releases to bridge supply gaps and put downward pressure on oil prices, protect the vulnerable with targeted support, direct cash, food aid, and temporary subsidies for heating and public transport. Push for safe shipping corridors for essentials like grain and fertilizer to avert humanitarian crises. Businesses must harden operations, diversify suppliers and inputs away from single-region risk. Hedge energy exposure to stabilize costs. Optimize routes to cut fuel burn and adjust fares dynamically to reflect higher costs. Build redundancy, just-in-time needs buffers. Strengthen finances, reduce near-term debt and secure reliable credit. Communicate transparently to sustain confidence. For agriculture, secure alternative fertilizer sources and adopt resilient techniques like precision farming and improved crop rotations. The 2026 Iran war, regardless of its duration, offers profound and urgent lessons for the global economy. It has exposed deep vulnerabilities in long, complex, highly optimized supply chains. Immediate triage matters, releasing reserves, rerouting cargo, providing aid. But the long-term solution is building a more resilient system. Lesson 1. Diversify energy. Invest in renewables, modern grids, and reliable baseload while reducing gasoline dependence in transport. Electrify vehicles and expand public transit. Lesson 2. Fortify food systems. Diversify fertilizer production, build regional hubs, and invest in innovation and precision agriculture. This crisis argues for renewed international cooperation to keep trade open and markets stable. The war's cost is felt at the pump and the checkout. Peace is an economic dividend. Invest in diplomacy, stability, and cooperation for a resilient, prosperous future for all. Thanks for watching, and don't forget to subscribe for more amazing videos.